Startup bonds. This slideshow investigates an alternative to preferred stock as an arrangement for structuring startup financing. The world market capitalization of bonds is actually larger than that of equity. Where a note is a short-term commitment, bonds and debentures are long-term commitments, usually longer than 5 years. Bonds are often issued by governments, but they're also issued by all types of organizations, including private and public corporations. The duration, interest, and repayment terms of bonds are defined by contract provisions written into each bond. Venture capital investors almost invariably structure their investments in the form of preferred stock today. Like common stock, the properties of preferred stock are prescribed in state corporation codes and in the corporate articles and bylaws. Preferred stock represents an equity interest in the corporation, but it's considered a hybrid of both common stock and debt. Preferred stock is in a junior position to debt when it comes to liquidation and bankruptcy. However, it's senior to common stock, and dividends to preferred holders come before payments to common stockholders. Provisions written into the agreement entered into by the company and the venture capital investor when buying preferred stock ensure that the investor has control over the issue and sale of company shares. So the investors control when and how the company raises future rounds of funding, and it's the investors, through their preferred stock, that decide if and when the company is sold. The preferred stock usually provides the investors with the ability to elect directors, and other provisions are written into the preferred stock that provide investors with control over a range of significant corporate decisions. Common stock usually has advantages over preferred when it comes to declaring dividends. However, preferred stock is usually convertible to common. This convertibility allows the holders of preferred stock to achieve the best of both worlds: upside potential as common stock and downside protection when treated as a creditor. Preferred stock acts as a second class of common stock with a liquidation preference that's triggered when the company is sold. The preferred and common stock structures allow for differential pricing. The SEC mandates that common stock cannot be priced lower than 10% of preferred. Closer to IPO, the common should be repriced to at least 90% of the preferred share value. If the company had only one class of stock and the employees were issued stock at a price lower than the market rate, then the difference between the issue price and the market rate at the time of issue is taxable as unearned income. However, under the preferred common two-tier stock structure, the company is able to issue common stock to employees at prices significantly lower than the price at which preferred stock is sold to investors. In addition to providing the control mechanisms that venture capital investors seek, there are significant tax benefits to this two-tiered common stock preferred stock structure. However, the preferred stock model is often unpopular with entrepreneurs for a number of reasons. The founders lose ultimate control to the investors. Management owes fiduciary duty to the investors. Ratchets and anti-dilution provisions can dilute the founders, significantly reducing their percentage ownership of the company. Liquidation preferences can disappoint the founders when the company is sold at M&A, and the common stockholders find that one share of preferred stock is more valuable than a share of common stock. Investor syndication leads to standardization in the way all venture capital investors structure their investments. So there's remarkably little choice or variety in the investments offers made to entrepreneurs by competing venture capital funds. They generally offer preferred stock investments on very, very similar terms. As an alternative to raising finance through the sale of preferred stock, there are no legal rules preventing a startup company from issuing a bond. Essentially, the financing can be structured as a loan, convertible debt rather than equity. The interest can accumulate over time. The longer it takes the company to repay, the more interest is due to the lender. The loan can be convertible to common stock at a price that's preset and agreed at the time the bond is issued. The investor can participate in the upside potential of the company by converting the debt to shares at certain events such as IPO or acquisition. Redemption rights can enable the investor to put the note to the company for payment after a period of time, say 5 years. The redemption price essentially represents the repayment of the loan plus interest and can be predefined at the time the bond is issued. As a startup venture is a risky endeavour, the redemption price might be set at 2 times, 3 times, or an even higher multiple of the initial loan, representing an appealing return on investment. The SEC and federal securities laws govern the issuing of bonds as they're classified as securities. This means that the security must be registered with the SEC, for example at IPO, or it must qualify for an exemption from registration, such as a private placement. The private placement exemption is available for accredited investors only. Individuals or corporations with high net worth or high incomes. Until the bond converts to common stock, management does not owe a fiduciary duty to the note holders as they would to shareholders. Corporate law is for stockholders, but contract law is for debt holders. From the entrepreneur's perspective, there are some advantages to structuring a financing as a startup bond rather than preferred stock. The founders can retain control of management and the board of directors. Common stock holding founders get to decide when and at what price to sell the company. Likewise, the lack of veto rights to investors also enables the founders and employees to retain control over when and whether to issue further shares. The bond is also relatively easy and inexpensive to set up. Simple contracts are required, but the registration exemption and SEC filings are still necessary. With this bond structure, there's flexibility in the amount that can be raised from each investor, as the investors do not qualify for shareholder rights. There's little concern in raising smaller sums of money. Management does not have to worry about having to request shareholder approvals from large numbers of small shareholders, because the investors are actually creditors rather than shareholders. The investor is not a shareholder until the company is sold or shares are registered in an IPO, and the bond is converted to shares at that point for a very short period of time. There's flexibility in when each individual note is closed. It's not necessary to wait for all investors to close before banking the funds offered from an individual investor, as there is in many preferred stock financings. Liquidation preferences are provided by bankruptcy law, and it's not necessary to write these provisions into the contracts. A debt instrument like this bond can be offered to all accredited investors and is not restricted to venture capital investors. It's also quite simple to syndicate a round of financing using this structure across multiple investors. Of course, venture capital investors prefer the preferred stock model, but the startup bond may become increasingly appealing over time as a result of the following trends. There's a growing sophistication and the growing business skills of entrepreneurs. Many entrepreneurs now have extensive business experience, and they're not all pure technologists dependent on investors for advice about business. Low interest rates means debt financing is attractive to the entrepreneur, and the startup can offer relatively appealing returns to investors. There's a growing number of startups with capital requirements that are too small for venture capital funding. Startup costs in many technology sectors have dropped as a result of internet-based marketing capabilities and the ability to create new products by using interoperable building block components rather than invest in creating new products entirely from scratch. Many companies today don't want or need multi-million-dollar injections from venture capital investors. But the investor model is driven by the need to invest in sizable 7- or 8-figure chunks. The growth of private equity funds and other sources of funding could lead to a growth in these alternative financing arrangements for startup companies. Investors prefer the now familiar preferred stock model as it provides them with more control over the startup company. But law firms have also become attached to the preferred stock model. It helps lawyers win business from venture capital investors. Lawyers seldom question the appropriateness of the preferred stock model for their startup clients. In venture capital, the preferred stock investment model has become a standard, and it would be very difficult to encourage venture investors to adopt an alternative form of convertible debt. The emergence of startup bonds as funding instruments for startup companies could go hand in hand with a new portfolio model for participating investors. This may involve an investor making a larger number of smaller investments and taking a passive role when it comes to managing the company. A $1 billion fund may translate into several thousand startup investments under this model, while it currently translates to less than 100 investments using the prevailing venture capital preferred stock business model. This form of investment may lead to the successful commercialization of innovative new technologies, more hot new products being acquired and marketed by large corporations that have existing routes to market. Currently, the venture capital preferred stock model relies upon a small number of home-run returns from the portfolio investments. So venture capital investors often use their preferred stock control rights to veto company sales where the M&A transaction they consider to be too low and not provide sufficient return to the investor. They often veto transactions that are less than, say, $500 million in value. The investor's veto rights can be excluded from the startup bond agreement, and the decision to sell the company under this structure will rest in the hands of the founding entrepreneurs and the other common shareholders. This will result in acquisition offers of $100 million or less being accepted by startup companies, and more products being acquired by large corporations that are looking for new products and revenue streams. Bonds are not new, neither are startups, and the financing of startups with convertible debt has been practiced in Silicon Valley for decades. Preferred stock is certainly the prevailing instrument for investments today. However, this is not the only form of financing, and entrepreneurs are encouraged to appreciate that there are alternative methods of structuring startup finance.